Each panelist will talk about two of his favorite issues or the issues which they find most important. So if I ask these 6 topics, it's 3 by 2, right? We'll stay on this so you can see what's coming. But we also asked after each kind of mini presentation, after each panelist talks about his favorite topics, another panelist to comment from kind of different perspective. And it will take us like probably an hour, but then before going for drinks, we will have half an hour Q&A. I'm sure you will have a lot of questions to panelists. I do already, but I will ask you to hold your questions to Q&A sessions, which we will start in 50 minutes probably. And speaking about different perspectives, so we have here people who represent risk management perspective, quant perspective, trading perspective. And that reminds me of the real life story, like there was this competition for cats. Who is the best cat, who can pour the milk from the jar into glass the best? And there were 3 finalists, and owners of the finalists were risk manager and quant and trader. So and the first cat owner, risk manager, came and said, my cat's name is stressed var. So Stracy, show what you can do. And the cat ran to the table, and the table, judges sitting at the table, and it had like big jar of milk and 3 glasses, and the cat poured like 97.5% exactly in the glass. And it was measured exactly, everyone is applauding. Next is quant, and he said, my cat's name is Black Shows, Blakey, show what you can do. And Blakey runs to the table and takes his glass and her glass, and put like 1 over square root of 2 pi. Not like 0.4 like some people approximated, but just exactly, it's to the 7 digit, so it's measured. Everyone is applauding, everyone is excited. Next is the trader. He came with his cat and said, my cat's name is John Paulson. Johnny, show what you can do. And cat slowly comes to the table, look at judges, look at other competitors, and then drinks the milk from Stracy and Blakey glasses. But of course it wasn't CVA trader. But that shows different perspective, and that some trading can take a lot of milk from other people's glasses, what we saw in JP Morgan case, and what I'm sure panelist Paul, I know, will mention this. So without further ado, I will turn my microphone to Paul. What do you think are the most 2 important issues?
Well, 2 important issues we've got here at the moment, so probably hedging and how to hedge CVA. I don't know how to follow the joke, by the way. I'm struggling here, but I'll do my best. And the second topic I wanted to talk about was certain hazards of central clearing in terms of the way that it's being implemented at the moment. I do feel there are a number of big iceberg risks coming that will hit the marketplace, not least the obvious ones in terms of the Eurozone crisis, but also the way that the regulation is being back-ended in terms of its implementation before 2013. So I just want a quick recap of CVA, because I'm not sure of the knowledge base of people here. I mean, primarily in the CVA book, the CVA calculation coming from EPE profiles, you'll find that there is sort of first-order risks coming from the underlying mark-to-market of the derivative portfolios. And that combined with credit spreads in terms of the probability of default give you your CVA exposure. So looking at those 2, in a multi-currency portfolio, something of long duration out to 30 years, even if there are ETOs involved, you've got a combination of credit risk, spread risk, credit correlation risk, either cross-gamma in terms of the underlying portfolio, correlation in terms of wrong-way risk potentially with counterparties. You would have interest rate risk and FX risk. The top 2 in terms of interest rate risk and FX risk can pretty much be taken out at a macro level. You can look at the whole portfolio, you can rebalance on that basis. But looking at the credit component, this is one of the most troublesome areas, and obviously given market liquidity issues, curve issues, basis issues, this is something I want to focus on now. But taking that sort of typified portfolio, let's see what we can do to take it from the top. people tend to hedge the overall portfolio dynamics, the credit dynamics, using index CDS. That brings problems of its own, which I'll go through later. The policy would be to cut individual tall trees down with single name CDS where possible, it's obvious, and then use index CDS for the rump end of the portfolio that's liquid by inferring a rating-based curve to them, somehow constructed in terms of average ratings, average CDS from around the world in terms of trading. That can be broken down by region, by portfolio. But the second split in the portfolio would have to happen in terms of beta, because we can't take the whole portfolio of various different credit spread levels and put it straight to IG or main in terms of the US and Europe for the indices. We have to split it up across the higher yielding indices as well. Hedge ratios, they're not direct. They never will be direct. Currently, people tend to look at their exposures with a mix of historical probabilities, whereas the hedges are obviously market-implied probabilities of default. So there will always be a rebalancing issue when it comes down to managing these hedge ratios. And this is causing quite a lot of concern in the marketplace. I'll go on further in terms of some examples of that in a little while. But when we do this sort of hedging, the problem is with CVA is its expected loss. An expected loss only gives you an average loss across the portfolio. As we know, the life and times are not that simple, and we have fat tails in there. We have unexpected loss to deal with as well. So we have to be careful at the crossover point where systematic movement becomes contagion. And that barrier area is where liquidity starts drying up. Now, there are many factors that can bring this into the marketplace. Contagion can be brought upon by a political issue, a bank run, but it can also be brought on by changing this market infrastructure. And that's one of the comments I want to make later on in terms of the hazards of central clearing. That's in terms of the live portfolio. If you have a failing credit, you can try and hedge out your exposure at default through market risk hedging. But we've got a problem there. And we've got a problem that's enshrined in some of the new regulation that's coming in terms of the ability or inability to be able to put hedges on in a market risk sense without it attracting extra capital. Now, this is a big problem for everybody in this room who's involved with CVA. We understand the regulators are talking and the banking groups are expecting to get some movement, but that can has been kicked further down the road in terms of the regulators' capital, the traded market regulation review that's coming through probably between now and June. They failed to address this in February, and that's a very, very key point because it creates a disincentive for hedging, especially for failing credits. Now, if you're only allowed to hedge CVA with CDS or a credit-related item, you're missing out on a whole world of possibility in terms of reducing your exposure at default. That's a big point I wanted to make. For failed assets, one must look at recovery, and the definition of recovery is 1 month after default rather than final recovery. Again, a big difference, and there is an active recovery lock market that's out there. You have to do it on a bilateral basis. People have to be prepared to take the risk. But there is an increasing move, especially amongst the shadow banking area, i.e. non-regulated funds, that will be prepared to wait for final recovery and take the bet on whether that'll be improved from what they were quoting in terms of 1 month after default. So those are a couple of issues there. Other problem areas in the portfolio. Concentrations. Now, this thing may seem fairly obvious to people who are students of sort of portfolio theory, but it's less obvious or it's less hedgeable if you happen to be a regional bank with a regional banking franchise and you happen to be successfully marketing to corporates in that particular region. It's understandable you will generate from that business, from your own franchise, concentrations which you can't easily get away. I have no easy solution for this. We do hear in the marketplace recently that whole portfolio swaps have been taken, or credit-enhanced structures where people try to put the assets off the balance sheet into third parties and take a first loss tranche in order to be able to minimize the capital associated with this and reduce their exposure to certain regions. But there is also a second aspect of this, and that's sector interdependency. You may find, for example, that banks in a certain sector, to use a classic illustration, will suffer if a sovereign fails. Now, we're faced with a very brittle situation at this moment in time in terms of confidence in the Eurozone. Even the politicians are now casually speaking about the possibility of a Greek exit. Whether that's priming the market, I don't know. But if that happens, it won't just be a recession in Europe. There will be some very, very severe consequences, not just for the population, but also for the banking system as well. Because I do not believe, and I'm sorry to be so bearish on Europe, I do not believe that the firewalls that are currently in place or the political will is there to save it if that happens. Everything's been moving to actually try and kick that particular can down the road for the last couple of years. And with each kick, it's getting more and more explosive. And that is a key iceberg risk for everybody in this room and the whole banking system. Speaking about sort of minor risk or lesser risk, shall we say, spread risk. The problem you've got with hedging is that the dynamics of spread movements are asymmetric. They go up very, very widely, very, very quickly when the fear hits the marketplace, and then ratchet in quite slowly as contagion or as fear comes off. As people find that the carry is too much to handle, so they wish to sort of sell more protection and bring the price back down again. That means that if you're behind the curve in terms of hedging, very often you found that if you're a big player in the marketplace, you cannot get protection at the price that you want. And a lot of people, instead of rushing into the trade, have now discovered that since 2007, they'd rather hedge later on and wait for the cycle to turn or try and take alternatives and proxies. Now proxies, a quick word on there. Proxies, in terms of economic hedges as opposed to direct hedges, and there is no perfect hedge in this marketplace. Absolutely nothing in credit. Maybe in market risk, bar friction costs, but in credit risk there is no perfect hedge. If you try and offset your position with somebody else, you're creating counterparty risk again. So it may be a never-ending or diminishing return, but it is still there and still a function. You still have to worry about legal risk, about whether you can actually enforce any CDS, and even if you're CSA'd, for example, there's a whole host of problems out there in terms of being able to take the cheapest to deliver option in multi-asset CSAs, funding issues if it's multi-currency CSAs, which is going to be the cheapest to deliver currency coming at you. I know there are certain comments to be made in terms of funding. And this is, in actual fact, as CSA, let me put it this way. Some organizations with counterparties, they tend to actually separate CSA counterparties in their risk management process from non-CSA counterparties. I personally think this is a wrong move for several reasons. CSA counterparties do have risk, not least in terms of the 10-day lag you get if a payment is defaulting, or if a counterparty is defaulting before you can actually start any legal action. There is market risk before you can close out. But there are varying flavours of CSA in terms of either their frequency, their threshold, and their minimum transfer amount. Even tight CSAs in terms of daily with zero threshold and minimum transfer amounts of zero, they still present risks to the organisation. Add to that the possibility of collateral disputes, which are fairly routine, especially if you're running a derivatives book that has exotics in there. This causes a lot of issues. I wish to jump to an area of problems in the marketplace that we've been encountering. Increasingly, CVA books are becoming concentrated, and with their co-management aspects of DVA as well as LVA, the tripos in terms of things that are really, really driving banks' trading arms at the moment in terms of concerns as capital becomes more and more constrained. We're looking at people with larger and larger positions in the marketplace to manage in single hand control or relatively small control. The problem is I don't believe market liquidity can take this, and it's becoming a very, very crowded trade. We can look at some aspects of that. In 2010, the Bank of England, its stability report, reported concerns that the 10-year area of the swaps curve was being distorted by potential CVA trades. The DVA issue, in terms of gaining from your own creditworthiness deterioration, is something I fundamentally and philosophically have a problem with because it's difficult to monetize as a risk manager. In 2011, for example, a large European bank made a 1.9 billion loss in terms of a trading error, and then the next quarter, at the end of it, reported a 1.8 billion gain in DVA. How is that happening? If your credit worthiness is deteriorating as you would implicitly expect from the fact that you had a trading failure, it's a problem. I wish to briefly allude to something that's happened recently on a prime US name. Basis risk, lots of people have analysed it. I don't think anybody really knows what the full issue and full extent of the positions are, most likely in terms of curve and basis risk. These positions do need very, very serious rebalancing. And when you find that the liquidity of the marketplace will not take that rebalancing, you find yourself with directional plays. And those directional plays can very easily get out of hand. And I have some slides here in terms of some graphs of liquidity and also the skew of IG9 over the last year or so. And we can see that from curve trades 5-10 years on there, that there were some very serious distortions in the marketplace that were put out. Quickly, in terms of hazards of clearing, so I've got a couple of minutes left. Local regulators are increasingly determined to clear currencies nationally or domestically. I mean, this is obvious from their point of view in the sense that they can keep control of local markets, they can make sure that their banks have access to these particular clearing facilities, direct access. And some of the international clearer have thresholds in terms of minimum swap denominations before they will allow entries. LCH ClearNet has this, for example. So we can see the drivers for this. Exceptions so far, interestingly enough, are Singapore. And Singapore has said that you can clear externally if you need to. The problems that are really created with this is what happens, for example, if you are required to clear domestically. You have a US institution doing a yen trade with a European organisation. Where is it going to be cleared? And these things are not clarified yet. There are too many amendments. It's being back-ended to the end of the year. The US seems to be ahead in terms of its implementation to the Dodd-Frank Act after the G20 decided in 2009 to go down this route. The implementation schedule seems to be ahead of Europe and ahead of other areas. So we've got structural risk, which could cause real problems if we have contagion in the marketplace in the Eurozone, not forgetting the fact that the US, even though it's a safe haven now, is going through an election year. And if people remember they had such difficulty agreeing a budget last year, I'm not so sure they'll be able to agree one post-election, and certainly not with the Bush deficit area fiscal stimulus maturing. So I think we're headed for a US problem after the Eurozone problem, or at the same time, and this is going to be exacerbated by clearing implementation issues. And I could go on and on. I'm sure I can bore you senseless, but I think I'd better stop there.
Thank you very much, Paul, and I really appreciate how you made concise, because Paul has very nice presentation, like for 38 pages, I believe, with graphs and everything, but we asked him to to pack it into 15 minutes, and he did a great job. Thank you, and those who are interested can talk to you after this. So, Simon, if you can please comment on this
Sure.
As a person who partly is responsible for managing risk for CVA desk. What do you think?
I'm going to ask him to provide all the solutions to my problems.
Very good. Thank you very much. Hello, everyone. Thanks for coming this evening. Yeah, there's so many issues there. Where do I begin? I think one of the first questions the CVA desk has to ask themselves is whether they're trying to operate like an exotic desk, hedging everything, hedging every market move, or as a kind of more long-term utility function for the bank, or somewhere in between. You know, there's a lot of legal risk, operations risk, and I mean, some of the risks that he's spoken about here can't be hedged day-to-day market. So probably senior management within the bank needs to have a certain tolerance for hedges that may not move day-to-day with any other risk. There could be tail hedges, basis hedges, and things that are difficult to model. But you know, a lot of the effort on managing the book has to be simply identifying the risks. I mean, we're all used to portfolios, maybe interest rate swaps or exotic desks, where the risks are fairly well known. I mean, they might be higher order, but they're fairly well known. But in CVA, really, a big part of, I mean, my day and my job and the risk management of it generally is just identifying what are these risks. You know, whether the timing risk of regulatory things, can you hedge them in advance it's a big risk for the bank as a whole. And that's something that I think we need senior management buy-in to allow us to run maybe more DVAR in order to hedge these things. There's one of the things he mentioned about waiting for the cycle to turn. Like certainly volatility is a big input into CVA, and so is credit, and they tend to move together. I mean, on a really bad day, falls of rates and FX and commodities, inflation move higher, and credit spreads tend to move higher. So if you're hedging them together, you'll end up, buying options because credit moved higher at very high option prices, and you'll end up buying more CDS higher when vol is higher. You need to buy more of it. So, on the one hand, I mean, not to pick a hole in what you're saying, but this is the difficulty. This is the difficulty. We've got Greece coming. If that's your view, which really means you do need to hedge those things, and you can't wait for the market to turn. There is no market to turn. It's exploding. So that's really the principal, question for hedging tail risks that we have here. Whether we can live through the cycle. Are we looking at a 1 year, 3 year, 20 year? I mean, they're doing 30-year swaps in your portfolio. Perhaps it's the kind of terminal wealth over the 30 years for the whole bank that is what is important. Or is it just the next 1 year? Or is it my mark to market today? Those timelines can give very different hedging strategies. I think looking at, in relation to the various basis risks you've mentioned, getting coherent stress tests is a very key part of measuring this and monitoring it. I guess everyone's seen so many stress tests, and it's difficult to know how important they are. Is it a 99.9% chance? Is it 1 over root 2% chance? And so on. And particularly, it's good to kind of put a price on it. Obviously, you need a lot of human thought to go. Is it a China hard landing scenario? Is it a Eurozone breakup scenario? But then you need to involve the market, basically need to use the vol surfaces as well to see what the market is pricing in, so that the different stress tests you present are coherent, that they're all roughly the same chance of happening. And then you can look at hedging some of them. On liquidity, I mean, my experience over the last couple of years in particular, hedging the book, is that the cross gammas, so when credit moves, my rates are moving. That risk, which is about the same size risk as the liquidity risk, like the amount of money it costs me each day or over the year, I mean, it's in the same tens of millions, and it's the same for other guys in the industry. So I really think it's a challenge for quantitative side to involve liquidity more carefully in modelling CVA. When you need it, as he said, when you need the hedge, it's most difficult to get. Bid offers are not something that can be ignored anymore, clearly.
I'm sorry, but you will have the time to talk about your issues. So it's not now, right? So because I'm afraid you will just tell us everything. And I appreciate all the comments. Unfortunately, I agree with everything, with almost everything.
I do.
Paul said,
I really
right?
do. Thank you.
Thanks, buddy.
Yeah. I know you guys kind of
haven't got
agree. Yeah.
I was waiting for the hecklers later on.
Simon, if you can please start with this.
That's fine.
That's
fine. I said my piece on what you said. Thanks very much.
Thank you very much. Now for something completely different. Andrew, what you think from quantitative? Simon actually created some kind of bridge and said, why don't you guys think about liquidity, right? But,
liquidity. It's quite a good introduction, but I think what I'm going to talk about here is liquidity in a slightly different context. So the two key topics I'm going to talk about today are FVA and CVA capital. But I'll start by talking about FVA, and I talk about this in four different things here. One is, what is it? The second one is, how do we model it? I'll talk a little bit about how you might want to think about managing it from a bank perspective. And then finally, I'll talk about the funding curve, which is perhaps the most controversial topic in the whole thing, and where you might get that from at the end. But let me start by saying, what do I mean by FVA? So FVA has been one of the hottest topics in quantitative research over the last 2 years. And funding valuation adjustment is one of the names it's acquired. Unsecured funding costs is another name, and liquidity value adjustment is a third name. But they all, broadly speaking, refer to the same thing, and that is the cost of funding unsecured derivative positions through the life of those transactions. It's, in a sense, it's related to another parallel development, which is about OIS discounting and the market move to OIS discounting, and I'll come back to how those two are related a bit later on. But it's been, broadly speaking, moved at the same time, and it reflects the fact that in the aftermath of the credit crisis, banks could no longer fund at rates very close to LIBOR, which is historically pre-crisis where they were able to fund. So the cost of funding became a significant issue for all banks. Now, to understand really where this comes from, I'm going to postulate a small scenario to motivate this. We can think about FVA in two different ways. One is to think about it in terms of the exposure on a derivative transaction. So if you think about an interest rate swap has this feature, and we'll come back to this, that it can be both have a positive mark-to-market or a negative mark-to-market. So when you think about this from a credit exposure point of view, it generates a positive exposure and a negative exposure. So what that means is that for part of the time you're effectively lending some money to the counterparty, and for part of the time they're effectively lending you some money, they're depositing money with you. So you've got an effective loan and an effective deposit. And in some institutions, from a credit perspective, those two expected exposure profiles, expected positive and expected negative exposure, acquired those names, expected loan exposure and deposit exposure. Now, what that means is, if you think about this in terms of a lending transaction, if you're lending just a straightforward loan, then today, because you can't fund at LIBOR flat, it costs you, and you have to borrow that money in the market to lend it to somebody else through wholesale funding markets, then that costs you money. So that's embedded in loan pricing through loan transfer pricing policies. All banks have loan transfer pricing costs. So FVA from a derivative perspective is a little bit like that. But it's a lot more complicated because, unlike a loan where you've typically got one-way exposure, you lend them the money, they pay you back in 5, 10, 15, 20 years' time. On a derivative, it can be positive or negative, so your funding position can turn from a funding requirement to a funding benefit throughout the life of a single transaction. So that's one way of motivating what this is. The second way, and perhaps the more effective way from a position management point of view, is to understand it as actually where does that money go. So if I do a derivative which is unsecured, so there's no CSA, there's no collateral arrangement with a corporate client, then what I do typically is I need to hedge the market risk on that position through the interbank market. Now the interbank market has got CSA, it has collateral associated with it. So if I had two back-to-back transactions, one transaction with a corporate client, when that's mark-to-market positive, for me, the hedge transaction is mark-to-market negative. On the client transaction, there's no collateral coming from that client, but I have to post collateral to my market hedge counterparty. So I have to fund that collateral. I have nothing that I can secure that collateral with, so I have to borrow unsecured to fund that position. And the reverse is also true, that if it's the other way around, if it's mark-to-market negative on my client trade, I owe them money, I don't have to give them the money today because there's no CSA agreement. I only have to pay the cash flows in due course. But I have a net collateral benefit because the hedge trade is the other way around, and that's given me a pot of collateral that I can potentially rehypothecate to other derivative transactions. So I've got a funding benefit from that. So that's really what FVA is and what it represents. The question then is, how do I model it? Well, the first attempts to model FVA were really through discounting curve adjustments. So in the roundabout the time of the crisis, people moved quite quickly to using a discount approach. So instead of using LIBOR discounting for unsecured trades, they moved to some kind of discount funding adjusted discounting. And that was the first approach to doing it. But I think latterly, there have been a number of other approaches which are more exposure-based. So if you think about my description earlier on, it's a lot closer to the calculation that you would do for CVA. in the sense that you've got an expected positive exposure and you've got expected negative exposure, and to calculate the costs you're talking about integrating over those exposures in much the same way that you would do for a CVA calculation or a DVA calculation. So there are, broadly speaking, two approaches to this in the market. One is discounting and the other is exposure. But the kind of drive towards these exposure-led calculations also reflects the underlying complexity in this, because it's not really just about funding the position. We talked about credit, and there's obviously a credit impact into the funding calculation, or certainly something that needs to be thought about. What happens if the counterparty defaults? Do I have to continue? Does my funding stop there, or does it cease? So there is inevitably going to be a crossover between the credit and the CVA piece and the funding piece. So that leads you down away from these simpler discounting approaches to more complex exposure-driven approaches. The other issue is there's quite a lot of complexity in derivative transactions. So if you have, this is quite common, a mandatory break clause on a transaction that terminates that deal prior to the actual full maturity date, so you have a mandatory break of 5 years on a 20-year interest rate swap, that deal will close out with a mark-to-market cash flow in 5 years' time, absent some kind of restructure. So embedding those kind of complexities into a discount approach is much more complicated, because what discount approach do you have to use one discounting curve for the first 5 years and a different one for the next 15 years? It becomes quite complex to manage that in a discount approach. And then you start to have things like one-way CSA agreements where you're required to post collateral but not receive it, or vice versa. That adds further complexity to the situation and is much more amenable to an exposure-driven model. Now, there are, broadly speaking, there's a lot of different modeling approaches to this. There have been models driven by probabilistic expectation-driven approaches, and there are others that are driven by a more PDE-centric view of the world. My personal preference is for the PDE view of the world, because fundamentally funding is about modeling cash and cash flows, and it's a lot easier to understand it from a more fundamental level using a partial differential equation approach. That's not to say that you would necessarily agree with the published papers in this. There are obviously a variety of different things that you could put into your model. But all of these approaches draw a really critical point, and this is about double counting. And the key critical issue about funding is, we've already talked about this EPE and ENE approach, and we've already got that in credit. And the question is, so we've got it on CVA, your exposure to the counterparty drives your CVA, but we've already got this DVA term, this debit value adjustment, this positive benefit that comes from the fact that you might default prior to transaction maturity as well. Now, FVA clearly overlaps with that, because we've already talked about funding benefit as well as credit benefit. And a key topic of the conversation in the market over the last 2 years has been, can you take this double counting benefit? The market consensus seems to be, no, you can't. So that then you're forced to say, what do I take? Do I take a credit DVA, or do I take a funding DVA or a funding benefit? And that's further complexities added to that by accounting standards, which generally speaking prefer a bilateral credit approach right now and don't really consider funding, although that's changing quite rapidly, and there's obviously a lot of market criticism about DVA, and also there was a Basel Banking Committee paper on DVA in December, which is also quite critical. So DVA, the jury is very much out, but I think from an accounting perspective as well, it will probably disappear over the next few years, although that may not be the case. So a few words to finish off the section on FVA, just on desk management. Obviously, banks are moving towards managing this, as well as accounting for it. There are various different org designs. Some desks will manage it centrally, the same way as CVA, and some will prefer to manage it at a trading book level. And different models mean themselves to different management strategies. But it's clearly a big issue, and it clearly is driven by exactly the same things that your credit your credit and your CVA is managed by. So many banks, I think, are moving towards having the CVA and the FVA management in the same place with the same level of expertise. let me just finish off on this before moving on to saying a few words about CVA capital, by just talking about where this actual funding cost comes from. Well, I've already mentioned LTP, loan transfer pricing, and there's certainly a school of thought that it's actually similar to loan transfer pricing and maybe the same curve is the appropriate one. There's also some discussion around CDS and the interaction between DVA and funding. Is it CDS? Is it our bond yield? Is it indeed related to the bond CDS basis? But the problem with all of these approaches is that from an LTP approach and loans, it's not really the same as lending through a loan, because you have this asset and liability in the same transaction, the same portfolio. So it's not really the same, and it's a lot more volatile. So individual banks will set their own funding curves based on potentially around funding strategies, which may not term fund the whole portfolio. Generally speaking, in banks they don't term fund a loan portfolio, so would you term fund a derivative portfolio? It's a good question. So really the jury is still out on a number of aspects, including where you obtain the funding, and I don't think there's any market consensus really around what model you use or what funding curve you use to value your FVA off. But there's certainly a lot of debate, and I think it will start to crystallize over the next 12 to 18 months. So now I'll turn to the second topic, which is, I'll say a few words on CVA capital. Obviously everybody is aware that we have a CVA charge coming in under the Basel III framework being implemented through CRD4. Obviously we've already mentioned this, Paul's already mentioned this, it's a game changer in terms of the way the whole industry sees CVA, and it's also a game changer for CVA desks. From a modelling perspective, it's really critical to understand, be able to calculate these numbers, but also to be able to understand what they mean in terms of how, in terms of managing the position from a capital perspective. So part of my day job is now about understanding capital. It's about modelling capital. It's about modelling the lifetime cost of capital, something which was really perhaps not really part of the front office remit until very recently, but it's now absolutely critical. And understanding in very great detail what the capital impact of a new transaction is, how you might restructure transactions to reduce capital, to look at capital, all of these things and mitigation strategies are really important. But the next step is really understanding the kind of the impact, and Paul's already spoken about the issues around how much capital reduction you will get for mitigation for credit hedging. And he's also mentioned that we have this issue that we can only get mitigation currently for credit hedging from using CDS and single name CDS and index hedges, and potentially CCDS as well, contingent credit default swaps. Now there's still a lobbying exercise ongoing to do with market risk hedging. Market risk hedging has clearly been an issue and clearly been a major part of and is of the day-to-day management of CVA. So the jury is still out on that, but it's clearly putting in some complexity into how you would view this from a bank-wide perspective. And from a modelling perspective, there's lots of questions about how much mitigation do I take if I'm calculating the cost of capital, how much am I going to hedge it, how much benefit am I going to get. And to kind of complete the complexity around this, we still don't really know what the final form of that is, and we won't know that until maybe around about July. We'll get CRD4, and then we'll get local regulator implementation very close to the actual deadline. So it's a complex and difficult, and also a moving target. But I'll finish off with just one comment on that, which is this from a modelling perspective. And it's a rather interesting conclusion that was reached in a paper that I saw at a recent conference, and that is the difference because under Basel III framework, you have two choices about how you might calculate the capital, the CVA charge. One is the internal model method, and the other is the standardized method. Now, if you have IMM approval, you calculate it in a similar way to the way that you would calculate your accounting CVA, and then you use your credit VAR model to generate the actual capital in a similar way to the way that you do for market risk capital today. If you're standardized, it's a standard formula. Now the issue is that this is going to drive some interesting differences in behavior in the marketplace, because if you're a standardized bank, then you will see the capital charge in a different way to the way that IMM banks. The numbers are going to be different. But because the IMM institutions are driven by their VAR model, it means that the particular details around the stress calibration of their VAR model will drive rather different behavior and different capital costs for different institutions. In particular, the interesting result of this paper was that actually, potentially, if you have as an institution, you have a very big spike in your CDS spread during a crisis situation, that it means that the calibration of the stress VAR is much more penal to you. So counterparties will find it a lot more expensive to deal with you if they're on IMM versus if they're on standardized, which is driven by a rating. So there are lots of complexities in understanding the modeling of capital as well as the actual implementation, and a lot of this is not really realized in the marketplace, but it's going to be coming on stream over the next year and then over the, as implementation beds down.
Thank you very much, and it's very interesting. Paul, would you like to comment on some of this?
Yeah, if you don't mind, just a couple of things. I mean, I fully agree with Andrew in terms of the complexity and the different modelling approaches. I guess where the rubber hits the road is what happens when you're taking a new deal on in the portfolio and having to price it. You'll find that CVA, less DVA, and potentially LVA become hurdle rates as running spreads on the deal. And there's heavy competition out there in the marketplace to ensure that the deal, especially if it's a large syndicate with a large swap on the back of it, is brought to the organisation for future flow. Now, there are competitive offsets and decisions that have to be made. For example, I have experienced, and I'm sure a number of you have experienced, conversations between the CVA desk and the LVA desk, if they're separate and they're managed at a transaction level, that something may not be so good for CVA, but it's good for the overall liquidity situation, and therefore the trade gets done with the reduced CVA attached to it. I mean, this is the trade-off and the interaction between the liquidity requirements of an organisation and the CVA requirements that really doesn't necessarily come out, especially if this is being held and managed centrally, i.e. away from the trading desk. We've got to get back to the idea that if you wish to influence behaviour in the business, you have to put that back to the point of transaction and work out what the marginal cost to your portfolio is of these various activities, liquidity management, funding management, and also CVA. So, I mean, I appreciate that it sounds very clean and clinical from a theory point of view, but when it comes down to actually executing, there are various competing requirements together with getting the deal done, because if people actually put the barriers up and no more business was done, we might as well just go home now. So that's the comment that I would leave with.
Okay, thank you very much. That's very interesting perspective. And Simon, can you please talk about your two most favorite? Yeah.
Zero order risk. Okay. First of all, thanks, Andy. Zero order risk, it's kind of just my word for it, so I better explain what it is. We've all seen, second order risks, gamma, vega, correlation, third order risks, skew, first order risks like delta and carry. Zero order risk, though, is just for CVA desk, like, is the trade in the system? Not just is the merchant market moving at what rate when FX moves, or when FX moves twice, what rate does it move at? Just simply, do we have the merchant market? This is, zero order risks are basically the operational risks for a CVA desk. And for me, kind of at the coal face, they've let me away from the coal face for an hour now, but really it's just almost the biggest part of the job. We have millions of trades, we have thousands of counterparties, we have dozens of currencies, dozens of different commodities, and then, obviously over the last few years, even pricing an interest rate swap has become complicated due to funding and collateral and other considerations. So really, from an operational point of view, the CVA desk is at the bottom of hundreds of different conveyor belts in the bank. And if anything goes wrong in any of the feeds, it can be really tricky. So, I have a couple of very simple pictures. Here is a Venn diagram, two circles. This is, my main risk management tool, basically. On the left-hand side is my model, and on the right-hand side is reality. And, hopefully they overlap, but there are a lot of things in my model which probably don't correspond to reality, and a lot of things in reality not in my model. And I'm not talking about, skew or smile or anything like that, which are difficult enough for CVA. I'm talking about, I'm missing the 5,000 trades done in Mexico last week because the guy didn't tell me. Do I have the market data for all the different inflation curves in the bank? There's so many different things to pull in. All the different credit curves, all the different CSA assumptions, all the different netting assumptions, all the legal agreements. It's a huge challenge for any bank to manage this. I mean, just to kind of quantify how much I think this matters, an interesting measure to look at is just take all your CVAs and take the absolute value of how much they all moved every day, due to whatever number of factors. So say that, in my experience, adding them all up, the first order moves, so delta, like rates moves, FX moves, inflation moves, credit moves, account for, on my book, on average over the year, about 85% of the moves. So, I mean, as Paul said earlier, you can take out a lot of those risks, with macro overlays. Of the remaining 15%, on an exotics desk, one would normally think, right, probably 85% is first order, 13% is second order, and then the rest third and higher order. For me, really, it's kind of 85% first order, 5% second order, so gamma, vega, and so on. And then of the remaining 10, it's 8 for zero order, this, and 2% of higher order and unknown. So it's really bigger than, it's a bigger risk for CVA desks than gamma, vega, correlation, skew, and so on. Just the operational risks. Specifically, to give some examples, I mean, how many names do you have in your book? 6,000, 20,000. Week on week, they're changing. You come in, back to your Venn diagram, 200 names have dropped out and 230 names have come in. And simply understanding them and focusing on, are the market data correct? Is the CSA nettings and so on correct? Are the trade representations correct? Is very tough. I think a very useful exercise, I think, for a CVA desk, as well as predicting your own P&L, is to predict the P&L on the whole bank. Like, does your system predict properly the mark-to-market of the whole derivative book of the bank? And it's a very good way to check, are you on top of these zero-order things, zero-order risks. Other problems which are, this isn't just Barclays, this is throughout the industry. As people who've moved from Barclays will say, CVA has been around for many years, but many of the systems and ways of operating within the bank haven't been. So CVA has generally been plugged onto other systems. Things like break clauses, trades being restructured. Am I still hedging a deal that Exotics Desk cancelled last week or 6 months ago? Has that company defaulted last week and just wasn't in the news because it was too small? And I'm still hedging it. Did my feed come in from Japan in the morning? Does that kill my whole batch? These are the issues which we're faced with day in and day out, really practical issues. To actually get clean risk every day is a massive computation. I think across the major banks, there are literally quadrillions of calculations done every night for CVA, like actually quadrillions, 10 to the power of 15. If you think of the number of scenarios, the number of Monte Carlo, the number of stopping dates, the number of trades, and the number of names, it just adds up and up. It's a little bit humbling. I come in the morning and do 6 or 7 hedges. After all these calculations are done, I feel there aren't as many degrees of freedom in the system as that. Basically, it's good to have a very simple understanding of as I said, this Venn diagram for a start. What's my risk yesterday? What's my risk today? Why did it change? But secondly, for CVA itself, if you actually do have your positions, it's my equation. I don't know if it's legible. It says CVA is roughly, okay, ignore the Z for a second. It's roughly credit multiplied by exposure. And exposure being mark to market plus vol. Okay, so the exposure, as Paul has mentioned, is what's the likely mark to market of this deal, and then the volatility. You need to include that because we're really interested in what if the client owes us money when they default. Right, we're doing max mark to market 0 or min mark to market 0 if it's on the DVA side, but essentially mark to market plus vol. You got credit that's multiplied by credit, so it's the mark-to-market plus vol at default, if they default. Z is so that used to be the way people monitor it. Just look at basically credit multiplied by mark-to-market plus vol. That's what you got to think about. And there's a lot of discussion about is the CDS and mark-to-market right way or wrong way? You know, is it a dollar ruble trade with Gazprom, and maybe if they default, ruble has fallen? This kind of discussion. Generally, people, I mean, in the market, have not focused on so much the credit multiplied by vol, which alluded to earlier, which generally will always be wrong way. So this term here, credit by mark-to-market, may or may not be right way or wrong way, but credit by vol, I mean, they always go bad together. The new thing, which is, well, it's not new, but it's what everyone has to focus on now much more, is Z, I think. Z is simply a 0 or a 1. Do I have this risk? Is it in my system or not? That is, you know, should I be hedging the DVA or not? Should I be hedging capital requirements coming or not? Should I be hedging, do I have a break clause in my system which shouldn't be there? Or one that isn't there that should be there? Really, I think the quants of the industry have spent, you know, many years now and come up with fantastic mathematics, some of which works, some of which hasn't worked so well, of focusing on really the higher order risks of a derivative book, of vol, skew, CMS, convexity adjustments. I think someone here was one of the first people to mention that, and so on. They've been brilliant advances, but I think now really the kind of intellectual capital of the bank and horsepower has to really focus on, I mean, some of the risks that you know Paul has mentioned here in particular earlier, and I've alluded to with the infrastructure of the bank. If I have, again, as I say, millions of trades in the system, and I come in and I think I'm long 300 million euro on my CVA and I need to hedge that, really, it's the real risk there is the operational risk. I think that is just completely wrong, that I'm just looking at the wrong numbers. And I can do a brilliant trade, I can even overhedge and think I've made some money, but then it's, you know, there's 50 million missing somewhere else. The JP Morgan situation, I mean, I don't really know the details, to be honest, but in a sense, obviously the number is very big, but in a sense, it's not too surprising that there should be some big, you know, P&L when regulators and banks are encouraging hedging things that weren't being hedged before, such as funding, credit, capital, balance sheet in general. And, you know, the liquidity pool available, again, Paul mentioned this, that is there, you know, isn't really designed for hedging that. Who's on the other side of hedging a bank's balance sheet or CVA or funding? It's kind of they're often very one-way markets. So I think a lot of care needs to go into hedging something like this, maybe slowly, and considering what the rest of the industry is going to do. Again, that's another Z. Should we be doing this or not? Other zero-order risks are like billing. So new trades happen. New trade, electricity swap done in California last night. Is that picked up in billing? Does the guy even know about a CVA desk? There's like thousands of people in the bank, and only so many of us. So billing and good communication to the rest of the bank, and, you know, buy-in from senior management is really vital in order to avoid a lot of these zero-order risks. You don't want to find that, you know, someone did as I say, an electricity trade a year ago and is expecting you to be hedging it. It's just not in your system. This is such an important issue, really. I would prefer to have, you know, my zero-order risks on inflation trades that aren't so big for me compared to my gamma on my interest rate book. I'd rather have all the inflation trades and their mark-to-markets in the system and not know any gammas in interest rates. It's just so important that you have the actual details there. Sorry, a couple of minutes. Okay. I think, yeah, there's a lot of common sense has to go into finding these risks. You know, for example, just simple common sense, like 90% of your risks is probably in 10% of the names, and exploiting that when running your batch at night when you're running your risks. Maybe on the more abstruse things like maybe aluminium, maybe 99% of the risk might be in a handful of names, whereas say euro interest rates, probably you need, you know, 20-30% of the names to capture 90% of the risk. And I think, you know, again, from the quant point of view, quants previously have been really focused on what's the value of this trade and all the effort in there. And then they move to what's the risks on these trades and calculating them. Now it's really what's the risk on the whole batch for the whole bank. You could even say in funding, you could argue that you need to almost consider the impact on the whole bank's derivative portfolio when a new trade comes. Normally, for each counterparty, we consider what's the marginal impact on my CVA with this counterparty. But in funding, depending on how you fund your book, and whether you're considering maybe funding spread moves, or actually, do I want to be hedged in default? Like, do I want to be able to tell George Osborne that if Barclays go bankrupt, it'll be zero P&L for the taxpayer? I mean, I'm not sure we can say that yet, but depending on how you want to manage a book, you can get very different outcomes. My last triangle, last 10 seconds, is simply this, a triangle, which is roughly, I think, all you need to know about cross-gamma and correlation for hedging a derivatives book, like CVA, because there's so many other important things. It's simply when A moves, maybe euro interest rates by this much, how much credit protection do I need to buy? And that's basically cross-gamma. If you can reduce all of your risks as much as possible to this triangle and this Venn diagram, I think you'll have a good handle on your CVA. Thank you.
Well, thank you, Sarah. Everyone applauds. I will let Andrew to answer on Quant's behalf just in 1 second, but just my comment that we decided there will be no slides, but Simon found a wonderful way to get around this. So thank you for Okay, so Andrew, please. What do Quants do?
What do Quants do? Well, I'll keep it. I'll keep a couple of comments really. The first one is that Quant's primary responsibility is building models. I spent the last 3.5 years at Lloyd's, considerable amount of time building, leading the building of a new CVA system, and I spent an awful lot of time worrying about data quality. Is very simple stuff like you get your data from a credit system, from one system, and you get your trades from another system. And is the name in the credit system, is that the same counterparty that is in your trading system? And where you've got a whole hierarchy, where does it fit? All of those things are really, really important from a CVA perspective, and understanding the data quality issues and getting the data quality right at inception, and then keeping the data clean is really, really important. And quite often, if you get a big CVA move in a name, and actually, is it a data quality issue rather than a model or a market move issue? So, I speak from experience. Smaller portfolio, but generally speaking, it's a big issue for what we do on a day-to-day basis. And the first question you ask, if there's is it a real move? Is there something a problem with the system? You've got to understand that. I think the other thing from a practical point of view, from a quant perspective, is, actually, this is a very complex calculation. It's a very expensive computationally, lots of grid cores doing this. So the first thing is you've got to make sure it's okay having a fancy model, but it's got to run every day on a reliable basis. You can't afford this to fall over frequently because you won't get your risk right. So there's a very practical element, I think, from a quant perspective, which is robustness, making sure that your model works perfectly well, handles errors gracefully, doesn't fall over in an unfortunate manner, because with this complexity of calculation, it's a very expensive thing to get wrong on a regular basis. And the other one is just really efficiency, and making sure that the calculation is really efficient, because it's absolutely critical. It's not just a modeling challenge, it's an engineering challenge. And you have to put the two together from a modelling perspective. So it just doesn't work to have an isolated quant and technology infrastructure. The two have to be brought together. They have to walk hand in hand to any kind of solution. And it really has to work very closely. They have to work very closely together, or it just doesn't work.
Thank you very much. I think let's thank all our panelists. It was extremely interesting. So thank you very much. And